Hello and welcome to Investing Confidential. Fed meeting coming on Wednesday, 50 points baked in. Some people talking 75. I'm going to tell you what really is going to happen and what the effects are after Wednesday's meeting. So the Fed decision is coming. Everyone knows. We've seen a lot of data coming out the last 2 weeks. Remember back, folks, a few weeks ago when Powell was talking at some conference and people took it as he was dovish and the market had a massive move, right? Well, the massive move was probably because everyone was bearish and we still see put call ratios and other things out there. Most professionals are bearish. So there is a bearish sentiment out there for sure. And any kind of positive news can make the shorts run for cover. Now, this is what these are. These are short covering rally. These are not people investing. These are traders in short covering. This is not long term money. And this is why these rallies don't last. And they're not going to last because we're in a bear market and these are bear market rallies. So let's talk 50 basis points. That's done. Okay. That is done. There's some morons out there today on CNBC and other places saying 75 basis points. He's going to go. We think Powell's going to look. Powell's not going to do 75 basis points. Okay. It's not what he does. 50 basis points for sure. But remember, it's not about the number. Okay, it's not even if he goes 75, and that's 2%, 10% chance goes 75, but it doesn't matter. It's about the wording, okay, and the conference call. Powell is going to have his speech, and most likely he's going to be hawkish. This is the modus operandi of Powell, okay? 50 basis points, is baked in. The market may have a short-term rally, but when Powell starts to speak, most likely he's going to be hawkish on his speech, and then the market's going to tumble because look, certainly the market doesn't like hawkish speech. It's gonna obviously strengthen the dollar, so you're going to see things like gold and other things probably sell off and stocks sell off on this hawkish. And that's my bet, right? I'm not a genius, but this is what I'm thinking because this is what is modus operandi of. Why do I think that? Certainly, it's because I think that we have seen what we have talked about. If you've been watching my videos, inflation is coming off. This is why people are encouraged. They see Yellen. Yes, they talking about that. I don't agree anything Yellen says, but I do agree that inflation has come off because I've been noticing this over a month ago. If you watch my videos for a couple of months, I've been saying inflation has come off, but inflation is sticky. Okay, and it's not going to come off to anywhere near the Fed target. So, what has the Fed been watching? They've been watching wage inflation. Okay, we're seeing this across the board. So, the negotiations with the rail workers, we're seeing California go to $22 on minimum wage. All of these things are going to contribute to sticky inflation, meaning that look, these rate increases are crushing demand, and we're going to talk about that in a second. But there's so much wage inflation. There's other things going on that we're not going to see an inflation target or the Fed target 2%, as I said before. They'll be lucky if they get 4% and then they begin to stop. But the Fed is not going to stop. Okay, they may stop the big 75 basis, but they're going to continue 50, 50, 25, 25, 20. They're going to hit you with these things throughout 2023. I don't see it ending. Okay, because inflation is not going to come down anywhere near the Fed's target, and that's what you have to look at. So, terminal rate, which is really important, we've spoken about this many times. It's going to be above 5%. It's probably going to go to 6% before it's said and done, sometime next year. The 2 year, which is about a little less than 4.5%, is going to go way over 5%. That's terrible for stocks. If I can invest in a 2 year treasury, which essentially is riskless as an American, okay, no currency risk, and I can get 5%. Why would I invest in stocks with earnings coming down and rates going higher? It makes no sense. So again, money's going to flow out. Now, there's a lot of studies out there, and maybe I'll do one video on these studies. But essentially, there's a lot of studies that showing historically. Then this is data. This isn't pie in the sky surveys that the government throws out there to you about CPI. When CPI hits above 8%, it has done that over a period of time, over the last, let's say, 80 years or 100 years. It takes a very long time. It takes a lot of pain for that inflation to come down. meaning it doesn't come down anytime soon. It will come down to about 5%. That's going to stay there. So historically, it takes 3 to 5 years for of pain. I call it pain before inflation comes down, starts to come down to levels below 5% and below, let's say, historical norms, which is 2.5 to 3%. That's a long time of pain, folks. And that means that rates are going to stay higher and there's going to be alternatives to stocks. Remember Tina? Tina's dead. There is no alternative. That's gone, and there's going to be alternatives. So this crazy move into this crazy moves in equities we've seen over the last 3 years or last 5 or 6 years is ending. It's gone. Okay. And the bottom line is that, don't get excited because the Fed all of a sudden is going to stop raising rates. They're going to do that, and the CPIs come down because they've crushed the economy. They had to. They had no choice. The economy is reeling, folks. Look at auto demand. It's gone. I mean, people, every auto company's incentives. Literally 3 months ago, they tried to charge you 10,000 over sticker. Now they're begging you to take a car with incentives. This is how fast things are. Well, this is how much of a scam it was before, and how fast things have turned around. Housing demand. We've talked about this. Housing demand is falling off a cliff. The reason housing prices haven't come down because nobody want to hit bids. The bids are low. Nobody's going to hit them, but they're going to eventually hit them because the institutions are going to hit them. They're going to hit bids all over the place, just like they do in the markets, and it's going to create this tumbling effect. So consumer confidence falling hard. You look at these employment numbers; they're fake. I told you about that. Look at these official versus again household survey. These are legitimate. These are people. These are actually contacting households versus, I don't know what the government does to bring up these numbers, but it's worse than the government saying. Okay, we all know that the employment rate, anyone who's in the real economy knows the economy is terrible. The employment situation is terrible. All there is these ridiculously low wage jobs out there. These wages are not acceptable. And this is why wage pressure is going to continue to go up despite what I think is, a terrible job market. So GDP recession, as we talked about before, I've shown this. This is the highest probability ever on records. It goes back to the 70s when these surveys start to go. I mean, folks, we're in it already. Okay, I don't care what anybody says, we're in it already, but it's gonna continue into 2023, in the middle, probably into the end of 2023. It's gonna be a long recession. We haven't had one of these since the 70s. Okay, so we talked about positioning. We talked about the pros being bearish. Now, I guess most of you out there are individual investors, and you're a little bit more again on overall. There's you guys are a little more positive. So we're going to see a little bit of an interesting situation here where you got the pros negative, retail investors positive, and it's going to come to a head this week because I think anyone who's been positive has been holding on the fact that we're going to get this pivot, and I think the Fed's going to show that there is no pivot. So I think it's going to be bad news, and we'll see how things react. But again, the positioning is so bearish, nothing would surprise me. A rally wouldn't even surprise me on bad news, but then it would fade. As I said, all rallies need to be sold. You talk about all this negativity. These are usually from a long-term basis the best times to invest. As you can see here, the thing that you need to focus on, again, for all stock markets, but especially for the US, because we are a consumer driven economy, that the best times to invest is when the consumer capitulates. As you can see here, have the consumer capitulated? No, not yet. We need to see the housing prices actually really start to tumble. We're starting to see consumer demand, housing, definitely cars tumbling. We're going to see it across the board. And if you're going to see, and the toughest thing to do is to buy stocks when you're in that situation, right? So you're going to see the market's coming down, the market's having problem, earnings revisions, all these banks. That's when you want to invest, when there's blood in the street, right? And you're going to see a lot of blood in the street, and that's the time when you should close your eyes, look at charts like this, like I just showed you. The best times to invest when the consumer capitulates, and there's a lot of other. But if you put everything together, we're getting close to there. I mean, close meaning we're getting a year or 2 years away from being an absolute bottom and another long-term bull market starting. And these bull markets last for a long time. The bear markets, not so much, but the bull markets for a long period of time. But it's going to be choppy. And the one thing I will say is that it's no longer being buying these indexes. You need to find good companies. Okay. That's what you need to focus on. And hopefully I can help you with that going forward. The best bargains, though, are going to be in Europe. Okay, right now. Europe is destroyed. The economies are much worse condition. They're just feeling the pain. And I think you're going to see Europe actually, believe it or not, come out of this quicker than the US for a lot of different reasons. And certainly, I think we're going to see some of the, in terms of valuation, if you look here, we're going to see the best value that we have out there in Europe and the emerging markets as well. So we'll come out with more recommendations in the future. But for now, if you're an investor, be careful out there.